All right. Good morning, everybody. So we're still holding in this range with WTI or Brent. We are looking at a TRB setup and a tweezer bottom. Kind of implies we're going to at least attempt to revisit these highs, whether you call it 86 in Brent or 80 in WTI. Kind of correlate the same thing with a USO chart. Asia closed up on the day. Nice little reversal candle, but still inside of yesterday's range. Europe is still going. Not quite to an inside day breakout yet, but a really nice red to green. Really strong recovery off of the lows yesterday. Opened today, kept the move, and now is looking for an inside day breakout. Considering it's 12:30, they still have a little bit of time. Might see Europe actually get this breakout that it's been working on. I'm not really feeling it though. All right, we got durable goods today. It's going to be a big one. And then we have European central banks and Fed speakers. And we have additional auctions today as well. I believe we'll see when we get over to Thinkorswim. If you look at FX Street, they've got durable goods highlighted pretty dark, right? This is how they gauge the anticipated impact on the market that this event might have. It's going to tie right in with the dot plots that everybody's watching really close. So we could see some fireworks off of that. But the whole day is kind of fraught with, these quiet little landmines. So definitely a data-driven market today. Keep your eye on whatever you use. I like finance juice, but just watch the clock, watch the news. We're going to be looking for a shift in the narrative. All right, as I mentioned, we do have additional auctions today at 11:30. And that's it. So once we get past those auctions, the only thing we're going to have left is any speakers that are out there chipping teeth. I was looking at cumulative volume this morning, and we're a little divergent. It has the same pattern, and we would expect that, right? Especially, say, on the weekly. It's going to follow the same kind of setup, and it'll have these lower pivot points. But the thing is, with the cumulative volume, it hasn't broke the trend line yet. And on the S&P, whether you're using, the ES or the SPX, we broke that trend line, solidly broke that trend line last week. So on the cumulative volume, we're still, kind of above the trend line. If we bounce off of that this week and get a push up in cumulative volume, we could see the S&P rally up off of this low. Just keep in mind, we're not thinking S&P back to 4,200. We're looking at, say, a small bounce off of support with a rally into a new minor resistance before rolling over and continuing the move lower. Certainly not a rally back up to 41, 41.5, 42. I don't see that on the table unless we get some econ that we just don't have at this point. So we could get that slight bounce. But I wouldn't expect much more than that. All right, we can see cumulative volume from the overnight session, which is a different volume than I was talking about. Coming in at around 100. It's fine. It's maybe a little bit light, but we've been seeing this light volume now for a little while, and it's not enough to cause concern. If it starts getting below 75, then we'll start to get concerned. All right, so 96, that's not that bad. 96.7, yeah. All right, we are still underneath the weekly pivot point, but we are working our way back towards it solidly. That should be coming into focus reasonably well. Look how far it dropped. That was last week's weekly pivot point. And now it's down here. The change of 1 week. No market maker move this morning. Now we are inside day breakout if you only focus on the RTH, which, I don't necessarily recommend doing that, but I know a lot of people do. It's a reasonably decent range that we have today. 40.23 on the top side, down to 39.47 on the downside. Call it 40.25 and 39.50. It's a 75-point range. Now we are trending up, reasonably well this morning, maybe starting to get a little bit of a topping pattern, building a bit of a base here. I wouldn't get too hung up on the patterns or the technicals this morning. It's going to be the econ that comes out, the response to it, and then Goldman's running some sort of investor day plan, and it's supposed to take most of the week. When Jamie Dimon comes out, chipping teeth, that man can move markets seriously. It's not Dimon this week. It's Solomon, but still he has the capacity and the forum to, throw some fireballs. So I'm just going to throw that out there. Keep your eye on if they publish a list of what they're going to be talking about, throw it my way. I'm going to be looking too. I haven't had a chance yet this morning, but just a note of caution, right? That not only do we have Fed speakers and the ECB out, but we're also going to have this Goldman event all week, apparently. If you listen to Seeking Alpha's breakfast podcast yesterday, they mentioned that Tesla has something going on this week too. Worth keeping your eye on that. All right, 10-day, 30-minute volume profile. We don't have a shape. Someone was asking me the other day what I'm talking about. Volume profile has a classic shape, a D, a P, a B, or a lowercase b. This does not resemble any of those, right? It's like a big mess, basically. So last week we talked about this air pocket. If we were to get that breakout, that we would move through this air pocket probably pretty easy and then get hung up right around that 40.90 area. But now we're below even that. So we would first have to get through the 40.11 area. It's got a lot of volume here. So 40.11 is a cog line. It takes us all the way to 40.20. 40.30 is the next cog line, so 40.11 and then 40.30. Just consider this whole zone a significant area of resistance. And while we're on this chart, that is a rising wedge, and rising wedges break to the downside. I'm just saying. So this little bounce is nothing more than a light bounce off of a minor support level. Likely a rally into a new lower resistance before we flip over and continue the move to the downside. We have a VPOC now from Friday, which is at 39.67. Now that's not a support level. It's an untouched point of control. When we interact with an untouched point of control, we expect price to respond there, like first touch bounce, maybe a slight consolidation, a lack of volume or volatility at that level, not volume, a lack of volatility at that level. Just keep in mind, they're not support, they're not resistance. All right, we're a 0.5% below the 10-week moving average. So really, we're just getting started. If this was to make a move in either direction, it has plenty of room to go. Since we're already looking at a downside move, getting around 3.5 to 4% away from the 10-week would be when we're just starting to consider that we might be a little oversold. We're nowhere close to that, right? We're basically at zero. So we're not overbought, we're not oversold, we're in the middle of the court. And that means that we could make a move in either direction, and it has a lot of room to travel. Now on the 10-day, last week we did get about 2% away from the 10-week, from the 10-day. We started pulling back to it. So we're closer to about a 1% right now. Generally speaking, we can usually complete a move, right? We move underneath the 10, we get a distance from it, and then we get above the 10, we get a distance from it, we go back below the 10. So, with that in mind, we've kind of gotten below the 10 and we're looking for that move back up. Just keep in mind, it doesn't always complete the cycle, right? That we can go down, come back up to the 10 and hit it and go right back down again. It doesn't have to get above it. This box represents the size of the expected move last week. So we can just take it and put it on this week. And you can see that this week, the expected move is a little bit more. The main difference between last week and this week is last week was a holiday week, so it was short, only had 4 days. This one has 5, and there's just a little bit more room to travel. Well, that kind of makes sense, right? We have an extra day, we have more time to make a move. And so the move is likely to be a little bit bigger, or there's just more time to go a lot farther. But that's really not a big box, right? Not like a representation that volatility really picked up or something, right? So there's nothing really on deck lifting volatility expectations. And the difference in between these two is likely nothing more than just the added day difference. All right, so we were talking about rally into resistance. If you look at the fangs, most of them are under the 10 and are making a push towards the 10 right now. Tesla's above it, NVIDIA's above it. But the other ones, Apple, Microsoft, Google, PayPal, Netflix, Amazon, all underneath the 10. That would very likely be the resistance that we're looking for. So a bounce on a minor support, a small rally into resistance before rolling over. As someone said the other day that it would be like a dead cat bounce. Yeah, and I can't argue with that, except, we carry a little bit more expectation on how much the bounce is going to be if it was to be a dead cat bounce. But shape wise, yeah, it's exactly the same. Right? We're looking for a little bounce, a rollover, and a continuation lower. Now, the good thing is it's not just the chart giving us this bias, right? It's that really explosive move in the 2-year on Friday, which took the 10-year and, well, it took the rest of the curve with it, right? And then the move in the dollar. Now, durable goods today is going to have a very large impact on the dollar, and the dollar should have a pretty large impact on the market. So it's a little bit of tit for tat on that one. We got US dollar Japan between 136.5 and 136. Got that 136.5 Friday. Kind of set the low. And we're just dribbling here. This is the one that I'm really keeping an eye on. And at 105.5 in the Dixie. So with the dollar index, we're coming up into a significant level of resistance. If we take a rejection here and start to dump, the anticipation is that the S&P is going to make it above the 10, get a pretty good push to the upside. It's still temporary. If we look at the Fed Watch tool, the changes that they've been pricing in, it doesn't seem like they're done yet. But we could get a short-term pop a little stronger than the 10 MA that we were just talking about. Now, a lot of things come back to liquidity. And at different times, different products represent that liquidity pretty good, right? It's kind of it's a rotating thing. So one of the things that we use is Bitcoin. Now, I don't trade this, right? It's a tool. It's like an indicator. We're just keeping an eye on it for a proxy of risk and a proxy of liquidity. With this weak and or fading, so is risk appetite, so is liquidity, and so is the expectation that the market can, or that we should be buying the bounce and looking for a rally in the market. So on Friday, we broke a pretty significant level, and we've gapped back up above it Sunday night. And right now we're holding it. But should we close the gap, that would be a nice primer or a warning, a heads up. I would focus on, say, the 4 o'clock gap. So right there. And then a break below the entire day. And I'm going to use the RTH. Will be a bit of a, so one will be the alert, the other one will be the trigger for a short, right? And again, we're not trading this, just using it for a proxy. In Bloomberg's 5 things you need to know, they talked about the China ADR and the China trades and how they are losing favor. They were the trade for the first 2 months, right? March. Looks like we're going to see that finally end, but through January and February, all those China ADR names got a lot of love. And that's starting to really fade off. So right now, 27 is kind of the line in the sand. As long as we maintain above that, we could see the destruction in those ADRs maybe kind of dry up a little bit. But if we break and close below this level, we're likely to see those other names really start taking a beating. Because I would argue they haven't yet. Baba, Baidu, Billy, PDD. Look at that thing sitting up near, the 1-year high. JD. All right. Well, maybe JD got a pretty good gut punch already. All right, so we're looking at the 10-year here. And just to kind of make things easier, I wanted to highlight this October high, right? When we got into 4.33%. And this is the October low in the S&P. So we set that low in the S&P, and it was a gapped down, mega massive recovery. That was the day that BOJ and the Fed worked together. They had that big intervention over in Japan, and we just had that monster, crazy, massive rally. And then we topped out in the next week in the 10-year. But we were sitting already at the highs, right? We were already at 4.05%. So we just got a significant breakout in the TNX. It needs to keep it, but this kind of goes with the whole idea that the market is squishy, it's soft. We're looking for a continuation to the downside, and that we want to sell the rips, not buy the dips right now, right? That you should be looking for short trades, maybe not with conviction, right? Not like buying puts, because when we buy an option, we need the market to get off its butt and really go. If the bias is, I kind of think we may sort of kind of go down, a put isn't going to do, and you're not really going to see much returns. So you can use a spread to kind of cut that down a little bit. Or you could sell a spread, right? Like, and momentum is what you want to use when you're buying an option, call or a put, because momentum implies we're going to get up and go somewhere. This is just kind of reinforcing what you're probably going to hear from more than just me, with everybody saying the market's weak, look for short opportunities, don't go long unless it's something in a solid confirmed uptrend that meets some kind of bigger picture, right? Like commodities, energy, precious metals, pot stocks. Some reason that a particular sector or industry or sub-industry is going to do good while the rest of the market isn't doing good. So check the beta on whatever it is that you're trying to trade and see how closely it correlates with the S&P. If it has a really low beta, then it's not highly correlated with the S&P, and it probably won't respond to this rising 10-year the way that the S&P is. Simple as that, right? That was easy. Nat gas is up this morning 3%. I wouldn't get my hopes up. We've had a lot of false starts. All right, so it looks like we had a little bit of a draw. We just seen the raid, and now it may be starting to make its true move, but it's not confirmed yet. So if you're looking for a confirmation trade to the upside, we don't have one yet. At the very least, if you're looking for a more defined trade, it would need to get above 8.9. that would still be an early entry, right? But it would at least be above this draw from last week. So this morning, the KWEB names are getting a little bit of a pop, but like I pointed out, the trend in those are down, and they talked about the same thing in the 5 things you need to know from Bloomberg. Since the last week of January, this has kind of been out of favor. You got the 5-bar rule. Doesn't always give you 5 bars though, right? So this kind of ties in with the S&P getting a small bounce. It's not expected to stick. We're not going to be expecting all those China ADR names to break this pivot from the 23rd. Just a minor bounce off of support. Bitcoin with a minor pop this morning too. Even semiconductors are up a little bit this morning. The dollar is nearly flat, and TLT, the bonds, are down 0.5%. So we got stocks up, bonds down, dollar flat. It's going to be a pretty choppy morning. We're not looking at a high correlation coefficient yet. All right, 18% of the S&P is up this morning, 0.5%. That's not overly bullish, right? It doesn't fill me with that warm, fuzzy feeling. No confidence. And look at the names that are in there. A whole lot of chip names. And then the monsters of tech. That's really what we got. Not really feeling that. For the NASDAQ, 35% of the NASDAQ is up 0.5% this morning. And again, that's not really awe-inspiring. So a bunch of China names, BDD, JD, chip names, and the monsters of tech. In that Wall Street breakfast, they mentioned that Tesla usually gets a little bit of a bump going into these events and then a sell-off afterwards. So kind of something to keep in mind. It's a free podcast. You can pick it up, wherever you listen to podcasts. So it's not like you have to have a Seeking Alpha subscription or anything like that to listen to the podcast. And it's only 8 minutes long. So it's short, it's sweet, it gets right to the point. It's worth listening to, right? Usually comes out on Sundays, by the way, if you want to, kind of put that on your list for things to do on the weekend to get ready for the new week. All right, so the heat map kind of just sums everything up really nice this morning. The market is mildly bullish. You can see the percentages here kind of give that away. 0.5%, give or take. We have tech and finance working together this morning. That's going to be the key. If we can keep those two working together instead of seeing tech versus finance, which we've been witnessing kind of more often lately, we could start to bleed into this high correlation coefficient. Now, for that to happen, we want to see 95, 97, 99 names out of 100, all doing the same thing, right? All driving to the upside or driving to the downside. If we don't see that, then we want to separate the divergence, right? Look at what sector, what industry isn't getting that push and see if it's going to be enough to stall out the rally up this morning. We got about 20 minutes before some fireworks are likely to begin. Keep in mind what I've talked about at the start of all of this, that this week is going to be a week where everybody's really grasping for data. And it's really this right side and lower right side that we're going to have the most problem with that correlation coefficient. Consumer services, consumer non-durables, utilities, communications, transportation, all of this little zone here, right? We don't necessarily need those. We're just talking about that rising tide lifts all boats kind of analogy. Tech can do it. Finance can do it. If we get tech and finance, should have a reasonably decent run. And it nearly always brings in consumer discretionary. And Tesla is like the biggest part of consumer discretionary, and that's up this morning. So we have all three of the risk on sectors. But if we start to break that and see a divergence, especially between tech and finance, then we could see it all start to kind of unravel and come apart. So the EVs are looking really good this morning. Li Auto had good quarterly results. And we can see with Li Auto, we also have XPEV up and Tesla is up. Kind of go through the list. If that starts to roll over those and they're up significantly, they would be a nice short from the highs. So I don't think it's going to dump today. But kind of keep your eye on these EV names, because if everything does start to roll over, they're the ones that have already made a nice push up, right? I'd rather short off the highs than off the lows. So certainly something to be focused on this morning. Fubo is nearly breaking this pivot point. So from the close last week with its earnings, now we're going to be opening very close to that line. That's a big, big gap up over this trend line. Now we're looking at it on the weekly. We can see that it's 50% of this big red candle. If you're looking at that thing, bulls need to get above that big red candle's 50% line and close above there. $253, and here in the pre-market we're at 251. So nearly there, but just getting there isn't going to be enough, right? It needs to close above it. Yeah, everything else just kind of seems squishy. Other than the EV names, I think the next place to kind of keep your eye today would be the financials. We have this really nice TRB. Could see a rally in finance. Kind of need to approach it with like a focus on the reflation trades, right? So XLF, XME, XLE. It's kind of the idea behind it. Everybody, be careful, be safe, have a good morning. Watch the news today. It's going to be a biggie. And I'll see y'all tomorrow.